So the other day I was looking at my projections for 2024 about the stocks and bonds and was analyzing the recent drop of all the markets because of recent Iranian attack on Israel and potential escalation of this conflict. So the markets reacted very badly, and regarding S&P 500, we almost back to 5,000 level. And when I open this chart, I think about where we currently at with the market. And as you can see that we now pretty aggressive decline. It is not clear about is it going to continue down or we're gonna see a rebound. Additionally, on top of the potential escalation of a conflict in the Middle East, we see that the inflation isn't down to a target set by Fed, about 2%, so it's 3%, a little bit more. So we currently see that inflation fight isn't over. And as you remember, in the end of 2023, everyone was more optimistic about the decline of inflation and afterwards a decrease of interest rates by Fed. And I remember at that time the market was estimating that in 2024 there will be from 4 to 6 rate cuts. So now rate is about 5.5, so it will be cut 6 times in 2024. Now we in April 2024, after the Middle East escalation, after inflation isn't down, after oil prices potentially go high, and now the market says that there will be 1 or 2 rate cuts until the end of this year, and now there are more and more fuzz about there will be no cuts at all this year. So it's a very interesting time we live in, and how we should react and how what our response to that should be. And let's look at the chart of S&P 500, which is 500 biggest corporations in the USA. And as you can see, these blue lines, this is how I estimated the movement of a market in December 2023. So I expected we will go down, after market will cool down after this story that the rates will be cut aggressively and inflation story is over. But as we saw that the market moved very optimistic to the level of 5,260, and it was a pretty significant growth. So I started my portfolio with Interactive Brokers in October 2022, like here. And as you can see, we went up a little, rebounds, and then go up again. And here I saw no, it can't be as good. So I expected it to go down, but I was wrong. The market actually went up a little higher, and now we see the rebounds. And currently we are in a stage of assessing what's going to happen next. And if we will look back a little more, we see that the market was doing very good in 2021. Amazing time for stocks, for crypto as well. But then the war in Ukraine started, roughly like here, and we went down. And actually, we reached the level of December 2021 just in January 2024. So it's like full 2 years to recover from that. And now when we crossed that line, so all new all-time highs for S&P 500, we crossed that, and we reached level to 5,260 and 70. So now we rebounded. And if we look that, if I invested everything in when I just opened my portfolio in October 2022 until the current level, it is plus 40% just in a year and a half. And yeah, pretty good. So now after all the recent escalation, we're down by almost 5% just in 1 week or so. So this is pretty frustrating. And what's gonna happen next? And as you can see that currently the level of escalation in the Middle East, it affects a lot the markets. However, you know what I'm thinking, that even though probably United States is a part of that conflict, but Biden told that they will not support the attack to Iran if Israel is going to make one. So it seems that United States are going to limit their part at that war, as well as they are limiting the role in the Ukraine and Russia conflict. And after World War II, United States were the one who actually got the major benefits after the war ended, as Europe was ruined. Japan was part of a losing side, and Soviet Union couldn't grow the economy because everyone was belonged to the state. So United States were the actual winners in terms of economy. And what makes me think that probably currently is a good time to invest anyway, because all these conflicts are away from the United States, and even though they can escalate and more countries could be involved in, I don't think that that conflict is gonna be at the United States soil. So this makes me think that American companies are still the best possible investment in the world. However, with the recent announcement that the rates will not be cut as soon as a lot of us expected, I turn my attention to the bonds again. And in this video, I want to talk about bonds and how you should balance your bonds and stocks in your portfolio. And there is a very well known rule called 60-40. It says that a simple investment strategy that allocates 60% of your holdings to stocks and 40% to bonds. And to be honest, this is a very classy rule, and I'm not sure that everyone follows that rule these days. However, the bonds start to look more and more attractive to me. In 2021, when the rates were about zero, I'm not sure that it was interesting for anyone to buy bonds with 0% yield. But currently, the 10 years bonds have the yields of around 4.5%. And as you probably saw my video about how I sold my car to bought a property in Thailand, a condo, to rent it out, and my calculations show that you get roughly 5% of yield if you're buying a property in Thailand to rent it out. So currently we have bonds which pay you 4.5%. And this is American Treasury. So actually, based on all the economic theory, this is a risk-free rate, because the only case you will not be paid back your money you invested into that bonds, and you'll not receive the coupon payments, which is interest payments for that bonds, is if United States will default. Obviously, no one sees that coming. This is the biggest economy in the world currently. So when I looked at my portfolio structure, I had about 85% of my portfolio allocated to the stocks. And the majority of that, roughly 30%, is VTI, which is the white index for all American listed companies. But I want to talk more about the bonds. So the other day I bought 10 years bonds, which expiration in 2036, with the coupon rate of 4.5%. The current yield is 4.46%. So as we can see that in the end of 2023, the yields for bonds were going down, as everyone expected the Fed cuts rate in 2024. But now, as you can see in 2024, the picture is not so optimistic, and things about to get sour. the yields are going up again. And for those not very familiar with the bonds, so you have the price of a bond. For every $100 of a face value of a bond, you have a price of that $100. For example, if you have the bond which the coupon rate, this is the interest the bond usually pays semi-annually to the owner of a bond, based on the face value, nominal value of a bond. So for 4.5%, it means you get in $4.5 for every $100 of a face value of a bond every year. So what happens if the actual market rates they go down? It makes the $100 of face value to be priced higher. So the bonds which have coupon rates about 4.5, and if the market rate go down to, let's say, 2%, the price of that bond will be about, I don't know, $110 for every $100 face value. So this is how it actually works. And here you can see this is the market rate, the market's effective rate for 10 years treasury bonds. And I decided to add that to my portfolio because looking at the stocks market, I'm not very sure about where it's going to go. And I'm already heavily invested into U.S. stocks starting from 2022. I have a very good average entry price for the stock, so I decided to add bonds to my portfolio and having the 4.5% of annual yield. And currently, my structure looks in the following way. Let's open that. Maybe I'll show more. No, it's a little bit outdated because the cash which is shown here, I already bought the bond with that. So it's about 40,000 investments into fixed income. I have 7,000 investment in real estate and 156 investment in the stocks. So it's about 20%, 40 divided into, it's about 20% allocation to the bonds. So currently my portfolio is balanced like 20 to the bonds and 80 to the stocks. And I'm wondering your opinion, how you think it should be balanced. To be absolutely honest, the historical performance of the bonds is much worse than the one to the stocks. So that's why you want to have more investments into stocks, obviously. However, seeing how volatile the market now, I remember back in the days of 2017, the traditional financial guys were harassing Bitcoin, saying it's very volatile. But come on, look at volatility for the stocks now. And it's very hard to estimate what's going to happen with them in the next months. But with bonds having the effective rate of 4.5% for 10 years bonds, which is actually risk-free rate. However, what makes me think it's not as cool as it may appear is that, if the inflation is 3% or can even be higher, this barely covers the inflation. However, obviously, on top of the coupon payments you get in, if the rates will be cut, the price of the bond will go up as well. So you'll get not just the coupon payments, not just the interest income. You'll get the income because the fair value, the price of that bond will go up once the rate will go down, and they will go down 100%. The only question is when, because currently 5.5 Fed rate, this is very restrictive for economy. If it's so hard to get money, having the rate of 5.5%, the economy will grow slowly. And this is the information given, which Fed gave to us, that they want economy to be slower. So I'm wondering, what is your opinion about how you think the portfolio should be balanced, taking account how cool the bonds rates are now, and that the stocks market is moving up and down so quickly, and so volatile these days. So what do you think is the best way to balance your portfolio. Please leave your ideas and thoughts in the comments, and see you. Bye bye.